Have you ever heard the term swap and wondered what on earth Wall Street is talking about? A swap is simply a contract where two parties agree to exchange cash flows. The most common example is an interest rate swap. Let's say Company A has a variable rate loan, but wants predictable payments. Company B has a fixed rate loan, but thinks interest rates will fall. They can swap payment obligations. Company A gets fixed payments. Company B gets variable payments. No actual loan changes hands, just the cash flows. Banks, corporations, pension funds, and even governments use swaps to manage risk. Sounds boring, right? Well, swaps became famous during the 2008 financial crisis. Many financial institutions used a special type called a credit default swap, or CDS.
A credit default swap provides protection against default. This contract transforms into a shield, absorbing risks. The institutions are now protected.
These were designed to act like insurance against loan defaults. The problem?
A CDS seller promises protection to many buyers, but the promises pile up, far exceeding the reserves. A credit default swap transfers the risk of default. A single default can trigger a chain reaction. As losses spread, financial health plummets. The crisis expands throughout the entire system.
So, swaps can solve problems by helping organizations manage risk.
Swaps can be dangerous when used improperly. They can be misunderstood, mispriced, or heavily leveraged. This can lead to serious problems.
Why should individual investors care? Because swaps are often hiding behind the scenes.
Swaps? I'm not sure I get it. Swaps are contracts to exchange cash flows, helping manage risk. I see. Swaps are important for managing risk. Got it.
You don't need to use swaps, but understanding them helps you understand how modern finance really works. And sometimes, that's where the biggest risks are hiding.